In the whirlwind year of 2023, the investment landscape has been unlike any other I've ventured through since my early days of investing. Think about the rookies just starting 7. It's akin to sailing choppy seas without a compass. That's where this video comes into play. We're here to offer you a beacon, a guideline that'll ensure you don't get caught in the storm. Will this single video morph you into an investment prodigy overnight? Probably not. But it will arm you with the tactics to thrive amidst turbulence. Here are 5 golden nuggets, not just from me, but revered ones the likes of Warren Buffett swear by, to keep you ahead in the game. Firstly, mastering your emotions, especially in preparation for any downturns. Think of Jordan Peterson's wisdom about being the rock during family funerals. Apply that stoic mindset to your investment decisions, especially during or after market crashes. Picture this. Most investors are ecstatic when their stocks rise. They proudly share their wins over drinks and become emotionally tethered to the market's highs and lows. However, the real victors are those who see declining stocks as a sale, a chance to buy more at a bargain. Over time, these investors comprehend that purchasing stocks at a lower cost leads to richer returns in the long haul. This is precisely why Buffett advises, the stock market is a device for transferring money from the impatient to the patient. The mantra remains, buy low, sell high. Yet, many ironically end up doing the inverse. Our second treasure is to invest in familiar territories. Want to outshine others? Dive into sectors you're intimate with. Take a moment to reflect on industries you comprehend deeply. If you're of a younger generation, this might be realms like gaming, AI, or the ever-evolving tech world. Those more seasoned might find their edge in established sectors like hospitality, gourmet foods, or travel. Buffett, for instance, swears by time-tested business models he grasps deeply. Whether it's the simplistic allure of See's candies or the intricacies of the insurance sector, his choice reflects his understanding. Emulate that. If you're a gaming enthusiast, you'd likely have insights into the next big thing in that space. This resonates with Peter Lynch's wisdom. Know what you own and know why you own it. Yet many investors spread themselves thin, striving to profit from every sector. Their knowledge remains surface level, lacking depth and conviction. Avoid that pitfall. If you're gleaning value from this discussion, consider subscribing to the Wealth Mentor channel. We're dedicated to empowering you on this financial journey. There is no fluff, just real, actionable insights. The third goldmine: diversify, but don't dilute. Here's a paradox. While investing in familiar territories is crucial, placing all your eggs in one basket is a game of high risk. Diversifying your portfolio can act as a safeguard against unpredictable markets. But there's a caveat. While diversifying, ensure you're not diluting your focus or expertise. Venture into sectors adjacent to what you know, slowly broadening your horizons. For instance, if you're into gaming, why not explore esports or virtual reality? These spheres may have overlaps that you can capitalize on. Next up, stay educated. The financial world isn't static. It's a dynamic, constantly evolving, and demands constant learning. Books, seminars, mentorship, online courses. Today, there are myriad ways to stay updated. Make it a habit to consume knowledge regularly. Remember, as an investor, your most potent tool isn't money, it's knowledge. Our fifth and final gem: patience is key. Rome wasn't built in a day, and neither will your empire be. The journey of investing isn't a sprint, it's a marathon. Resist the urge to jump on every next big thing. Instead, focus on long-term growth and value. Historically, the stock market has had its share of rollercoaster rides, but it has trended upwards over time. So, embrace patience and let the magic of compound interest do its work. It's imperative to underscore one thing here. Investing is as much about mindset as it is about money. Your habits, discipline, and continuous learning will define your trajectory. It's not about getting rich quickly, but about growing wealth sustainably. Building upon our third point, diversify but don't dilute. The story of Mr. James is quite enlightening. James, a friend of mine from college, invested heavily in tech stocks during the late 90s. At first, his portfolio soared, and he was hailed as a genius among his peers. But then came the dot-com bust. The value of his portfolio nosedived, wiping out his gains. The blow wouldn't have been so severe had he diversified across sectors. But remember, diversification doesn't mean investing blindly in every industry. It's about creating a balanced portfolio that mitigates risks while leveraging opportunities. As we touch upon stay educated, let's ponder a timeless quote from Benjamin Franklin. An investment in knowledge pays the best interest. Franklin wasn't explicitly referring to financial investments, but the wisdom holds. Economic instruments, market dynamics, and global events are continually shifting, reshaping the investment landscape. Warren Buffett, for instance, attributes much of his success to his voracious reading habit. It's said that in the early years of his investment career, he would read 600 to 1,000 pages a day. Now, while that's a high bar, the lesson is crystal clear. Continuous learning isn't an option, it's a necessity. Now, delving deeper into patience is key. Legendary investor Charlie Munger once quipped, "The big money is not in the buying or selling, but in the waiting." The world is rife with stories of investors who sold off too early, missing out on monumental gains, or those who panicked and sold at a loss only to see the stocks rebound in time. An ancient Chinese proverb states, "The best time to plant a tree was 20 years ago. The second best time is now." Investing embodies this sentiment. It's not about timing the market, but about time in the market. Now, a bonus tip for those who've stayed with us: cultivate a network. While solo research is invaluable, there's much to be gleaned from a community. Engage in investment forums, join local investor groups, or even discuss market trends over coffee with friends. Different perspectives can offer new insights, warn of potential pitfalls, or highlight emerging opportunities. After all, two heads or more are often better than one. Lastly, stay true to your principles. Every successful investor has a set of principles they adhere to, no matter how the market swings. Whether it's a commitment to ethical investing, focusing on long-term gains, or any other strategy, it's vital to have an anchor. This guiding light ensures you don't get swayed by the fads of the day and remain steadfast on your chosen path. Remember, investing isn't just about capital appreciation. It's a journey of personal growth, discipline, and resilience. Each decision you make, each success, and yes, even each setback molds you into a savvier investor. Thank you for journeying through these insights with us. Each point discussed today isn't just a tip, it's a pillar of a successful investment strategy. Internalize them, and they'll serve you well, not just in 2023, but for years to come. Before we sign off, here's a small request. If this content resonates with you, click on the like button. It helps us immensely. And for more deep dives and investment wisdom, make sure you're subscribed to The Wealth Mentor.